here are the best asset classes for you. Now in this video, we're going to dive in whether you should invest in stocks, bonds, real estate, cash or cash equivalents, commodities, or alternative investments. Now before we dive in, make sure you hit the subscribe button to keep up with all the content. Now let's start off with the most obvious investment, which are stocks. Stocks, also known as equities, typically represents ownership in specific companies. And typically stocks are sold by companies in exchange for cash to meet their own objectives. Now, there are two major ways to make money from stocks. One is by either paying attention to the dividend that it pays out, or two is paying attention to the growth. Now, these are two very different strategies in deciding which stocks you're going to be buying. Now, dividend investing is focusing on stocks that pay you a high dividend. However, these stocks will typically have a very slow growth rate. So while the price of the stock doesn't grow as much as another growth stock would be, for example, the dividend that they pay you may give you yearly or quarterly or monthly income that you can then put into other investments. However, if you're more focused on investing in growth stocks, that means you're going to be investing in more long-term stocks that have a potential to grow higher and higher in value, so that the value of your overall portfolio is growing. However, regardless of which investment strategy you're going to be choosing, stocks are typically for those with a higher risk tolerance and a longer investment horizon, as they offer the potential for significant returns over a long time. Younger investors in particular might find these stocks super appealing due to their ability to withstand market volatility and capitalize on compounding returns over decades. Stocks are one of the most recommended investments for any person because of their consistent returns over long periods of time. Overall, the S&P 500 averages a 10% annual return rate, which has been tested time and time again to give a quite accurate depiction of what stocks might look like 10 or 15 years from now. Additionally, seasoned investors who are well-versed in fundamental and technical analysis might also enjoy the thrill of stock picking and the potential for outsized gains. Regardless of either, it is important to recognize that stocks carry inherent risks, including market fluctuations and company-specific factors, making them unsuitable for risk-averse individuals or those with shorter time horizons. Although the S&P 500 averages 10% returns a year, there's still years where it goes in the negative. Because the stock market is relatively volatile and has day-to-day or week-to-week fluctuations, typically, it is a smarter idea to invest in stocks that only have a longer time horizon in order to capitalize on the return on investment. However, there's one caveat to this. If you are dividend investing, there are stocks that pay you a good amount of dividends, such as 6% or 8%. If these stocks maintain the value of their stocks while paying you that 6 to 8% dividend, they might be a smart investment because that dividend allows you to hedge against the volatility of that stock. So even if the stock does plummet in value, you're still getting cash in hand from that stock. So although growth stocks do require a longer time frame, if you're dividend investing, you might not need as long as time frame as if you were growth investing. However, like growth investing, there's always bound to be volatility within the market, so you still have to be careful with which stocks you choose. Now let's move on to the next asset class, which are bonds. Now bonds fall under the fixed income category, which is basically that you're lending money to an entity and in return they pay you a fixed amount of interest until their maturity date, in which case you can then take the money that you initially invested along with all the interest that it gained. Now these bonds tend to be incredibly safe as they're bound to pay you a fixed income over a long period of time, which in this case would be the complete opposite of stocks. Bonds appeal to a different subset of investors looking for stability and consistent income streams. Typically, retirees or individuals nearing retirement who prioritize capital preservation and steady cash flow tend to favor bonds. These fixed income securities often offer predictable returns in the form of interest payments, making them incredibly ideal for those seeking a reliable source of income to cover their living expenses or fund retirement. However, if we take a look at the average return on bonds, it is still incredibly low compared to the stock market. For instance, in 2023, the average 10-year US Treasury bond rate is still only at 3.6%. And with many banks offering high interest savings accounts that offer you maybe 4% or even 5% APY, bonds are currently not super attractive. However, because the interest rate does change every so often, you still want to keep bonds on your radar just in case the interest rate does eventually spike. For instance, I-bonds might be incredible when the inflation rates are high, but overall, bonds are relatively much safer than stocks would typically be, so they're more for investors who have either a shorter time frame or are a more risk-averse investor. Now, the next asset class that we have to talk about is real estate. Now, there's a couple ways you can invest in real estate. One is the obvious by buying a home, 2 is by flipping homes, and 3 is by REITs. Now, let's talk about buying a home first. Historically, the prices of homes have risen incredibly over the long term, with it peaking within the recent years. Real estate is an incredible asset because of all the things you can do with it. You can live in the house and just allowing the house to appreciate over time, or you can even rent it out for increasing your monthly income. However, the challenge right now for many people who are trying to get into real estate is finding a home that they can actually afford. A shortage of homes for sales has kept prices incredibly high in many different markets, and higher mortgage rates have also removed many buyers from the market. Overall, home ownership is a great investment vehicle, and over a long period of time, it works incredibly well for a lot of people. Real estate investments attract investors seeking to diversify their portfolios and generate passive income through rental properties or capital appreciation. Experienced investors with a keen eye for market trends and property valuation may favor real estate as a tangible asset class with the potential for long-term wealth accumulation. Moreover, home flipping is also incredibly valuable because of capital appreciation. In fact, in 2022, home flipping averaged a 26.9% return rate. And although it has fallen during the recent years, it is still an incredibly profitable strategy. However, you should expect that 20 to 30% of your profits will be spent on renovations, assuming nothing else goes wrong. However, home flipping can be bad, especially if you're stuck with a house that you can't sell for what you've invested into it. It is slightly more risky than just buying a house and letting it appreciate or renting it out, but overall it is still not a terrible strategy. And finally, we also have to talk about REITs, which are real estate investment trusts. REITs offer a convenient way for retail investors to gain exposure to the real estate market without the hassle of property management. Now, REITs function very similar to stocks, in which you're buying shares in companies that own real estate and you receive dividend payouts based on how much you invested into them. However, because they're also very similar to stocks, they're also much more volatile than the real estate market might be. For instance, in 2022, returns in this sector actually fell 37.6%, according to the National Association of Real Estate Investment Trusts, which gives you an idea about how volatile this investment vehicle might be. However, REITs are still a great way to diversify your portfolio without having to spend hundreds of thousands of dollars buying a home. Overall, real estate investments are more for individuals who have the ability to buy these rental properties for capital appreciation and passive income. However, investment properties do also take a lot of work, as you would have to manage the property, you'd have to manage your tenants, and so much more. If you're looking for a more passive and less hands-on type of investment, then I wouldn't recommend real estate. It is important to recognize that real estate investment requires significant capital, due diligence, and ongoing maintenance, making it less accessible to novice investors or those with limited resources. But like I mentioned earlier, REITs are a great way to break into the real estate market and to diversify your portfolio. However, it loses a lot of the benefit that comes with owning your own real estate. And next we have to talk about cash and cash equivalents. Now, cash provides a safe haven for investors seeking liquidity and capital preservation in uncertain times. Conservative investors, such as retirees or individuals with short-term financial goals, often allocate a portion of their portfolio to cash equivalents for emergency funds or short-term expenses. However, although cash is an asset class itself, I wouldn't recommend many investors investing in cash. Now, obviously, having a small stack of cash available for monthly expenses or an emergency fund is a great idea. Going overboard and holding on to too much cash is a bad idea. It's essential to recognize that cash equivalents offer minimal returns compared to other asset classes and may not keep pace with inflation over the long term, resulting in an actual loss of your purchasing power. Therefore, investors should strike a balance between liquidity and return potential when allocating funds to cash and cash equivalents within their investment portfolios. Although it is a way to diversify your portfolio and give you a great amount of liquidity, cash itself isn't a great investment, especially when considering how inflation has been over the past few years. But like I mentioned earlier, it is also crucial to maintain enough cash on hand to pay off your monthly expenses, as well as to keep an emergency fund that you can survive on for 3 to 6 months. But in my opinion, you should always be allocating most of your free cash towards other investments. Now next, we also have to talk about commodities. Commodities are typically basic goods that can be transformed into other goods and services. For example, precious metals such as gold and silver, energy resources, or agricultural goods. And commodities typically appeal to investors looking to hedge against inflation or diversify their portfolios. Typically, sophisticated investors and institutions with a higher risk tolerance may allocate a portion of their portfolio to commodities as a way to mitigate risk and capitalize on price fluctuations. Additionally, many traders and speculators may also engage in commodity future contracts to profit from short-term price movements in commodity markets. Moreover, commodities are also a great way to hedge against economic uncertainty, as they allow you to have a store of value. Because commodities are so crucial to the economy, they are in some cases viewed as a great hedge against inflation. Because their return on investment or ROI is based on supply and demand rather than profitability, many investors view commodities as a great way to diversify their portfolio even further. You can also easily indirectly invest into commodities by buying shares of companies that produces them. However, there's also a huge market for people who buy physical goods such as gold or other precious metals. However, it is also important to know that commodity prices can be highly volatile and influenced by various factors, including supply and demand dynamics, weather conditions, and global economic trends. Therefore, investors should conduct thorough research and exercise caution when investing in commodities to manage risk effectively and achieve their financial objectives. For me personally, I believe commodities are more geared towards short-term investors or traders. Because of their supply and demand dynamics, changes in the global economy create much more predictable price movements than stocks might be. This allows short-term investors or traders to make a quick profit from buying and selling commodities or buying and selling their future contracts. However, for a more long-term and hands-off approach, commodities might not be your best option. But at the end of the day, it is still a great way to diversify your portfolio overall, so still recommend everyone invest a small amount of their portfolio into commodities. And finally, we have to talk about alternative investments. Now, alternative investments includes art, tradable collectibles, Bitcoin, and so much more. They encompass a wide range of assets beyond traditional stocks and bonds. Now, the most well-known of these alternative investments is probably cryptocurrency, and mainly Bitcoin. If we look at the overall return of Bitcoin, the ROI of Bitcoin is absolutely incredible. And although cryptocurrency hasn't gone through its ups and downs, especially with FTX and crackdowns on Binance and Kraken, the cryptocurrency world is still going strong today with new SEC approvals for Bitcoin spot ETFs. Now, although cryptocurrency has had a rocky past, cryptocurrency may be an incredible investment in the future. However, like all the other alternative asset classes, you have to be an investor who understands what you're investing into before investing into it. And although the same could be said about all the other asset classes, it is so much more important within alternative asset classes. For the lesser known asset classes such as stamps, tradable collectibles, or artwork, you have to know and understand which product will have greater price appreciation than all the other ones, or you might lose value on many of your different investments. These unconventional investment vehicles appeal to sophisticated investors and high net worth individuals seeking high returns and diversification benefits. However, you have to keep in mind that alternative investments often comes with higher fees, limited liquidity, and greater complexity compared to traditional asset classes, requiring careful due diligence and risk management to navigate successfully. Investors must carefully assess their risk tolerance and investment objectives before incorporating alternative investments into their portfolios. In my opinion, you should only invest in alternative investments if you understand to a deep degree what you're investing into. And there you go, those are all the different asset classes and who should be investing into them. Subscribe if you enjoyed this video, and I'll see you all next time. Happy investing.